Hey folks, Vic here with your weekly video. And you know, Darko's long-term trading service has had like really nice success year after year for almost 6 years now. But with long-term trading, although the profit targets are much bigger than with short-term trading, so too is the initial pip risk, right? Which is often can be well over 100 pips or a lot more than that even. So the question is there a way to get in on a long-term trade if my account size won't allow for a bigger initial pit risk, because it would mean risking way too much of your account? And the answer is yes, there certainly is a way, and that's what this video is all about. Okay, so I really hope you like it. And if you like these videos, let us know just by hitting the like button. In fact, leave a comment letting us know your thoughts on these videos. If they're helpful, great. If not, let us know. Maybe we can help in some other way. Okay, and of course, the other thing you can do is subscribe to our channel by clicking the subscribe button in the lower right corner of the video. Okay, let's take a look at how we can take on longer term trades with a small account size. Hey folks, Vic here, and I want to talk about how to trade longer term if you have a small account size. It's an issue that comes up because of the larger pip risks that are necessary for higher time frame trading. And so we're gonna have a take a look at this situation here. Because if you only had a small account size, let's say $1,000, it could even be less. How can you possibly take on a longer term trade? So I'm going to show you how to do that, some ideas on that. And by the way, what I'm going to show you has pros and cons that you need to be aware of. Okay, it's very important to understand these. I'm going to cover them in more detail later on in this video. As you know, we recommend no more than risk exposure of your account of no more than 0.5%. So if you had a $1,000 account, 0.5% is $5. So for most currency pairs, that means you could risk up to about 50 pips on one micro lot. Okay, about 10 cents per pip. So 50 pips or so. If you had an initial risk of just, say you only had a 25 pip initial risk, you could trade a two lot, right? Because 25 pips would be $2.50. Since we can trade up to $5 of risk, you could trade two lots. So I'm going to show you a few real-time examples of trades that are on right now as we speak, as I'm recording this. And by the way, I'm recording this on June 9th, 2022. These are long-term trades that Darko showed in his PMA videos recently. You can go back and listen to them. So what you need to do, like I say, listen to the PMA, observe where the entry is for a long-term position, the one that Darko points out, based on Darko's PMA. That's step one. Then once price hits that entry level, and you can use a trade alert for that. You don't have to be sitting and watching it on your computer. Just put an alert on there. You have lots of time. You need to drop down to a lower time frame to find a valid pattern with a smaller initial pip risk. So let me show you how this works. So this is the New Zealand Canadian dollar pair. I'm not going to go through the PMA analysis. It would just take too long for this video. But again, it's June the 9th as I'm recording this, so you can go back and check Darko's PMAs just before that date and see what he had to say. So the buy for the long-term trade is at about 81.40. Okay, that's this. This is a monthly level. Again, I'm not going to get into it, but that was the buy. All right. And it needed an initial risk of about 90 pips. So that's too much for a $1,000 account, right? So what we do in order to try to get a lower pip risk entry is we drop down to a smaller time frame. Now it's up to you and your time availability, etc., how short of a time frame you want to go down to. Personally, I prefer the hourly chart. I don't like going much below that because there can be problems. I'll talk about that later. I like staying with the hourly. But the good news is once you put the trade on using the smaller time frame, you can get the risk out more quickly. And once that's done, you treat this as a long-term trade. Okay, this is a long-term trade. It's not, we're only using the small time frame to get in. But don't start treating it like a short-term trade if you want to be a long-term trader. And I tell you, the rewards can be very juicy. Keep in mind, the initial risk is still only 0.5%. Now, I'm going to go down to the hourly chart. It's this one right here. Here's where the entry was, this green line here, according to the PMA. So price comes down, goes right through it, rallies up, goes right back down, and now we start to bounce around in here. And this is where you can start to look for an entry. And by the way, I believe, if I am not mistaken, yeah, this was a really nice weekly and daily level down here, right at this level here. This is the hourly chart. And so look what happened though. Price comes down, it rallies up, it goes down, but now we have a higher low, and then it rallies up above this high. We have a swing break, we have background space, we have a, and like I say, there's a really good level here from a daily and weekly as well. This is a pullback buy. This is how you can get in on this trade with very small pip risk. And if you were to buy the 62% retracement, like you want to buy a pullback of some kind. 62% is around 80, 94. Your risk would be about 20 pips, not 90, 20 pips. Since you can risk up to 50 pips or $5, which is 0.5% of your $1,000 account, you can easily trade 2 lots, actually almost 3 lots. But let's just say 2 lots. Now you could go for an even bigger retracement, 79%, maybe this support level down here, okay? These decisions are what you need to come up with and do the same thing on a consistent basis. You know, don't base it on one trade. Oh, you know, I'm going to go for 88.6% all the time. Hey, you can miss trades. You know, price comes down and goes straight up, and you miss because you're trying to get a deeper entry. It's okay to get it. Just do it the same way every time and be, okay with your decision, and just stick with it. Okay. Now the profit target. Let's talk about this. And by the way, the entry with a 20 pip risk, you're up way more than that. We've even had this swing break again here. This is not a trade you lose on, right? Now you're in a no-lose trade, whereas the longer-term buy up here so far is in a losing position. But keep in mind, it's a long-term trade. You don't have to sit there and micromanage this trade, and you certainly don't have to do that anymore with this trade. This is a risk-free trade now, getting in on a smaller time with a 20 pip risk. Okay. The profit target on these, so again, this is not a short-term trade. Keep that in mind. Based on Darko's PMA analysis, you could be looking at least the highs of the weekly chart. That weekly chart is up here. That's up into here. You can see the reaction down again. That's alone right there is going to be over 200 pips. So on your initial 20 pip risk, you got a reward risk potential of 10 to 1. Okay, so that's what can happen with these kind of trades. Next, Aussie Canadian dollar pair. Okay, and again, listen, this is just illustration. Don't. I just want you to understand how you can take on these bigger position trades and swing trades without having to put in the initial pip risk. And it doesn't always work out that you get filled. Here's a case in point. On this trade here, the Aussie CAD pair. The long-term entry was at 89.85. Let me just make sure about that. Yeah, 89.85. Yeah, this line right here. You see here? Let me just bring it up. This is a weekly, monthly level here, right down into here. Look what it did. It just came down and just hit it perfectly because we front-run the orders too, by the way, right? This trade's been filled, and it's interesting, and it needs an initial risk of 90 pips. Filled to the pip could be a missed trade for a short-term trader though, because look. We can bring down to our 1 hour chart. Here is the level to buy at. Now you know that we front run these orders on these longer term trades, so that the buy was actually up higher on here. I'm going to call it 89.85, and prices started to move up. If it keeps going, you miss the trade. Okay, that's one of the cons. I'll talk about that in a minute. But maybe it'll set up. What has to happen for it to set up? Well, we need to see some kind of structure damage here, right, on the smaller time frame. We haven't seen that yet. Okay, so we'll see what happens with this. But again, this is one of the things that could happen. You may or may not be filled. We'll have to see. But definitely, if you're a longer term trader, you're filled. You're in. You're waiting for this. You just wanting this just to keep going up. Okay. So I want to now talk about the pros and the cons, and these are things that are very, very important to be aware of if you're going to do this. So let me just bring up my little PowerPoint here. And here's the pros with it. Obviously, one of them is that you can get a very small pip risk entry and have the potential for a huge move. And obviously, this is an effective way for a trader with a smaller account size to participate in big moves with very little initial pip risk. Okay. Also, one of the nice things about trading with a smaller time frame entry is that you can get the risk out of the trade more quickly than what you can with a longer time frame entry. So, for example, if you have, say, a 20 pip initial risk on a smaller time frame, price only needs to get up 20 pips before you can do something. You can start making it a no-lose trade. Okay. The other good thing about this approach is, you may end up avoiding a full loss on a long-term trade that just keeps going the wrong way because the smaller time frame, on the smaller time frame, you just never get a signal to get in. It just never has a pattern, never sets up. Okay. And finally, this approach could, not necessarily will, it could help you grow your account more quickly because you're taking on powerful long-term trades with big profit potential, but with very small initial pip risk. Okay. So those are things that are pros. Let's talk about the cons. You could completely miss the trade if price never gives you a smaller time frame entry. I just showed you that on the Aussie CAD. It might just keep going up, and we simply don't get in. The longer term entry makes money. The short term entry just never happens. Secondly, you do need to have some time availability to keep an eye on the smaller time frame. Okay. Again, I would suggest keeping it to the hourly chart. This shouldn't be too much of a problem for most people. When you get below the hourly, you're going to get more market noise. Okay, and which kind of brings me to the next drawback. You could be stopped out on a smaller time frame entry, especially if you're using like a scalpy entry, a 15-minute chart or something, and yet not stopped out on the higher time frame entry. So the longer term trade makes money, but the short term entry loses. That's possible. Okay. I just think that, I just think the hourly chart reduces the noise, gives you a better chance. And fourth, you do need to be on top of the initial trade management more than you would if you were trading longer term. Okay, so just be aware of that. Like on that New Zealand CAD trade, set an alert. You can just let me just bring this chart back up here. If you got it on this New Zealand CAD trade, let me see here. And by the way, you could set an alert above here just so you know when there's a swing break. This is on the Aussie CAD. Back to the New Zealand CAD though. What you can do is once you're in the trade, you can set your alert 20 pips higher or up into these highs in here. So when that alert goes off, now all you need to do is come back and do some trade management. Either move your stop to break even or take your profit there and leave your initial stop here. There's all sorts of ways to do it. I won't get into that right now. But you do need to be a little bit more on top of the initial trade management when you're using smaller time frames to get in. Once you've managed your trade, it's time to leave it alone. Let it go and see where it goes to. And that's how you can get in on these bigger moves. Okay? So I hope this video was helpful. Please let me know if you have any questions. Right, so I hope you can see that this can be a great way to be able to take these very nice long-term trades that Darko provides every week in his pre-market analysis videos, his PMA videos. They already have large profit targets, but if you can get in on a long-term trade as shown in this video, obviously the reward risk potential becomes gigantic. So the bottom line is don't let a small account size turn you off of long-term trading. Okay, well, thank you so much for watching this video. In fact, thanks for watching all of our videos for that matter. We really hope that you're finding them helpful. So just do two more things right now. First, hit the like button. Secondly, have a great weekend. Okay? Take care, everyone.